Hey everyone. If you've been watching Bitcoin lately, you've probably seen the headlines crash, bull market over, panic selling. But before we get swept up in the noise, let's take a breath. Today, we're going to cut through the chaos and focus on what actually matters for Bitcoin's long term trajectory. We'll break down the 100,000 support level, the Fed's tricky policy moves, Trump's trade wars, and why ETF inflows still look strong even when the price doesn't. There's no hype, there's no doom, this is just clarity. Let's dive in. Let's begin with Bitcoin's technical setup. There's three price zones which are critical for investors to monitor. First of all, we're bullish above 100K. A weekly close above this level signals strong bullish momentum. This level has historically acted as a psychological and technical support zone, attracting consistent buying interest. Second, we're cautiously bullish above 87,000. This 87,000 level aligns with the 20-week exponential moving average. This key technical indicator has served as a dynamic support since early 2024. A weekly close below 87,000 would break the 20-week EMA, and this will historically trigger sell-offs and signal a potential trend reversal. Why do we need to focus on the 100,000 weekly close? Well, there's three main reasons why this is our bullish level. First of all, market structure. So it maintains this bullish higher high, higher low pattern if we stay above 100,000. Because if we were to make another weekly top below this level, suddenly we would break the structure that we have going on over here. The second reason is investor psychology. 100K is a critical level psychologically for investors. It's a round number and it's 100. Anything below it seems a lot worse than it really is. Psychologically, 80,000 is a lot different than 100,000. So getting back to this level will essentially reinforce confidence after we see this volatility. Finally, 100K matters a lot due to it being a technical anchor. There are a lot of major institutional participants, including ETFs, which have shown increased activity near this level especially. Though this is kind of observational and not causal. More on that later. Finally, let's talk about the 20 EMA support. Historically, this is a crucial safety net, and a hold here suggests temporary consolidation as we saw from June of 2024 to September of 2024. Although we were going in between the 20 and 9 EMA, we did manage to consolidate around this period and not really fall towards the 100 or 200 EMA. So this EMA acts as kind of a safety net. However, a breakdown of this, so this would be below in these regions, 87,000, would mark the first weekly close below this level in 1, 2, 3, 4 months. So that's a 4-month long trend that we have been in. And that is a big deal if we break that. That's why I've marked these three sections. Over 100K is where we want to be, and this is where we're likely headed. Between 87 to 99,000, this is probable in the short term, but not really in the long term. So in 1 to 2 months, I think we can break out of this range. And finally, heading into the end of Q1, I feel that below 87,000 is especially improbable due to various factors like institutional buying pressure, Fed's activity, and just overall economic well-being. So more on this is coming, so keep watching the video to see how this is going to play out. So the Trump administration has levied a 25% tax on Canadian and Mexican imports, as well as an additional 10% tax on Chinese goods, and this will come into effect on Tuesday the 4th. So this is bad on the short term because of a few things. First of all, this leads to higher consumer prices. Tariffs on goods such as electronics and machinery, this is going to raise prices for US businesses and households. And secondly, it creates an inflation problem, which is already pretty bad. So Americans are dipping into savings to sustain spending, and the pressure from this, like the increase in prices, it'll worsen the effect that has on the economy and on inflation. And this is also going to result in a policy dilemma, because persistent inflation is going to force the Fed to delay rate cuts and keep borrowing costs higher for longer. And additionally, the impact this has on the job market can lead to an effect where we have something called stagflation. On the long term, though, this has two main effects. It slows the growth of the economy because prolonged trade wars, they risk disrupting supply chains, they reduce business investment, and they just reduce productivity in general. And as the BBC notes here, we could be entering a new era of global trade wars. And this retaliatory environment is extremely bad for investment purposes in the long run. But for risk assets such as Bitcoin and gold and silver, this could actually be a good thing. So let's consider the 2025 statement and in regards to slowing quantitative tightening. Right here it says, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. So as you can see, the Fed has hinted at slowing quantitative tightening, but right now it's not going to because liquidity just remains in contraction. But if tariffs deepen the economic pain, the only option the Fed really has to avoid stagflation is to halt QT and maybe even restart QE, or quantitative easing. And this is just going to inject money into the economy so that it can be stimulated, because tariffs are going to halt growth, especially in the short term. So now let's look at how this will affect Bitcoin, especially. The first off, in the short term, the risk-off sentiment from tariff announcements, this triggers a market sell-off because this leads to confusion in the market and uncertainty, and this is things that investors, they don't really like. So currently we're seeing this dip happen along with other equities because consumer confidence in the market in general just isn't good, and people are saving their money so they're prepared for what's to come. So although in the short term we are facing this dip right here, right? In the long term though, because of things I talked about earlier like inflation and global trade war and risking the economy, the monetary policy that follows could actually end up stimulating Bitcoin to push higher. Because a Fed trapped between inflation and recession is going to do one thing. It's going to resume money printing. And this is going to, reaffirm Bitcoin's digital gold narrative. And on top of that, trade wars often push central banks to inject stimulus into the economy so that your economy keeps going. And this increases global liquidity, which in the end will be good for Bitcoin anyways. Speaking of global liquidity, this is the chart comparing global liquidity in green to Bitcoin in orange. So global liquidity, which is the total money supply available to the financial markets, it recently peaked in September of 2024, and ever since then, it's been in a decline. And this downtrend reflects tighter monetary policies from central banks, which includes the Fed's quantitative tightening and rate hikes, which have, been seen all across the world. So for risk assets like Bitcoin, liquidity contractions historically signal short-term headwinds. However, let's look at this in a different view. Every single time global liquidity bottoms, Bitcoin has a 2 to 3 month lag where it kind of just consolidates, and then it follows the price action of global liquidity. So, as you can see over here, we bottomed here, Bitcoin did its consolidation, and then global liquidity rose and so did Bitcoin. Again, in 2023, global liquidity bottomed, Bitcoin consolidated for 2 to 3 months, and then followed global liquidity in the uptrend. And again, in June of 2024, we saw global liquidity bottom once again. And then we saw consolidation for, 2 to 3 months once again, before in October and then November, we finally followed global liquidity in the uptrend. Now we're here. We're in January of 2025, Q1, and it seems that global liquidity has once again bottomed. Now, as long as we maintain this kind of uptrend structure, we should be good to consolidate for another 2 to 3 months, and then Bitcoin will follow global liquidity as it pushes higher. So right now, we are here in January, and this gives us a target of, let's say 2 months, March. But if we really want to be a little bit more accurate, I would honestly put this in a range of March to April. And I think that we will consolidate until we get our next leg up, and this is the end of Q1. So now let's look at two critical angles when it comes to global liquidity. So first, we need to consider the tariffs liquidity pressures. These tariffs are going to worsen inflation, and this is going to force the Fed to keep the rates higher for longer. So tariffs are going to strain consumers, and this is going to tighten liquidity further. But prolonged tariffs, so if we get into a scenario where we have tariffs for over 1 month, this can force the Fed to reverse course. So if the GDP growth stalls, we can expect emergency rate cuts or renewed stimulus, which is going to be a liquidity lifeline for Bitcoin. Now finally, let's look at some Bitcoin ETF flows. So right here you can see that the ETF flows, they remain robust, and institutions are still averaging a lot of monthly purchases of BTC. So this consistent demand, this contrasts with retail panic during corrections. And this is like the biggest divide that you see, right? Your everyday investor versus an institutional trader. So as you can see right here, these green bars, they indicate days of inflow, and the red ones indicate days of outflow. Now you can see like outflow is obviously extremely important. I mean, these people have been buying Bitcoin since it was at 55,000. So they are going to naturally take profits on some days. And you can see that right here around the 90,000 level, we see a lot of buying pressure occur. So if we look at this and look to the right, you can see every time we're around 90K, the inflows go extremely crazy. Again, we were around 90K, the inflows went extremely crazy once again. Now, obviously, in the short term, even these institutional traders are going to take some profit so that they can re-enter once there's a lot of panic selling that goes around. But you can clearly see that around that 90,000 level, there is a lot of institutional demand for Bitcoin. So institutions, they view sub 100,000 Bitcoin as a long-term value opportunity. Now before I end this video, I want to talk a little bit about alt season. Everybody keeps wondering, when is it going to come? Is there going to be an alt season? What is going on? Why are my altcoins not performing? Well, the clear answer, and the only answer, is Bitcoin dominance. Bitcoin dominance being at 60% is the reason your alts are bleeding to death right now. This measures Bitcoin's share of the total crypto market, and for a sustained alt season, dominance needs to fall below 54%. And I've marked this with a red line because this level is the key level that gets us to the fabled alt season. Because this indicates that capital is now rotating from Bitcoin to altcoins. So until this threshold breaks, altcoins are going to underperform Bitcoin because there's ETF driven demand for Bitcoin and there's none of that for altcoins. So that dynamic is kind of emboldened because until we see these big institutions rotate their money into altcoin from Bitcoins, like nothing's going to happen. We're going to see this keep going up. You can see this was around the Trump pump. You can see Bitcoin dominance went to about 54.68% and then bounced. A lot of people here were like, oh my god, alt season, alt season, alt season. But if you were following me, I had called it out that no, this is not going to happen. Not until we fall below this level. And look what's been happening ever since then. We are now in a sustained uptrend. And this is horrible for altcoins, like extremely bad. That's why we see our altcoins down like 20, 30% when Bitcoin moves maybe 2 to 5%, right? This is the reason. So right now, sitting at 60% dominance, even if we fall to 57, even if we fall to 55, unless we're below this level, we won't see an alt season. Alright, let's wrap this up. So here's the thing. Markets, they feel chaotic right now. But when you zoom out, the pieces, they start to fit together. Yes, Bitcoin is currently below 100K, and all the headlines are screaming bull market over, sell, pack your bags, we're done. But remember, we are still hovering above this crucial 20 EMA safety net. And the Fed is still playing this weird game of we're tightening, but maybe not, next month. And meanwhile, our global liquidity has been draining since September. And Bitcoin always is a few months behind. So even if things look shaky right now, the real reaction won't hold until later, until we see more tariff news come out, maybe things get more messy, and the Fed has to introduce emergency measures. And you've seen this before, right? Like every cycle that we have a little bit of this confusion, we have this market cautiousness until things become straight and investors regain their confidence. And don't forget that the ETFs are still buying these dips. Every single dip, they buy BTC. Retail is panicking, but BlackRock is not. And that should tell you something. And as for your altcoins, I know we all want alt season. Trust me, I've been waiting just as you have. But until we crack below 54%, it's just not happening. So just have some patience. Load up on your positions, DCA, and let the macros play out. If you want to cut through the noise with us, just join the free Discord. We're tracking these trends daily. There's no hypes, it's just charts and chilling. No subscriptions, none of that. All free, we're just a trading community, so feel free to join us there. And feel free to subscribe, like, and share this with your friend who's sending you those panic sell headlines. The cycle's not over yet, and it's just getting spicy. I'll see you guys in the next one.